Good morning. Happy Father's Day to the public, and happy Father's Day to the SMF MMTs, and happy Father's Day to the international trader, investor. What we are looking at here is Goldman Sachs is up on the top, and down here is the S&P 500. And Goldman Sachs is the powerhouse as far as dealing in worldwide capitalism. And that capitalism is a way of gauging markets and bull markets and bear markets, because Goldman's always participating in the directional movement of these markets. And what we did over here in 2009, when Goldman was putting the bottom in, the S&P over here was putting a bottom in 2000. I'm just showing you how Goldman had ran. This is a S&P 2010 bottom here. I'm going to go back over to the other bottom. So let's get a screenshot of that for you, Mr. Flag. Down here on the S&P 500, I will draw a trend line. This trend line represents a bottom in the S&P. Goldman started making its bottom before the S&P. The S&P was still selling off when Goldman was making a bottom here, bottom up. And what does that mean? That buyers were stepping in, and they continued to step in for 60 trading days, 90 days here. And when it started at its uptick, the lag effect is here. We were still selling here when Goldman was putting the bottom in here. Now, Goldman started to take off and rip in its trend back in 2009. Notice that the S&P had followed suit immediately. We can clearly see that the S&P had lagged. It was putting a bottom in over here. Goldman had already gapped up. You can take a look right here in the second monthly bar. In the second monthly bar, they started to catch up. And Goldman ran and broke out harder to the upside in 2009 prior to the broader S&P 500 making its move. Okay? And the truth of the matter is how to use a Goldman in a stock like Google chart, even though that the S&P 500 is computed on 500 companies as to what those earnings and multiples and all of your standard retail stuff is calculated on and evaluated on. It doesn't matter. And Goldman is calculated and evaluated on the same thing. And Goldman was leading its way around the world at the time in the way that Goldman operates. That's why this S&P 500 down here had broke out and followed it right up with the trend. And this is when SMF said we were putting a bottom in the market back then. Then a lot of stimuluses were involved. And government was hard at work trying to make things better for its U.S. society. Economically, worldwide markets were breaking out to all-time highs as they were. And this also provided that move. That's the reality. That's the 2010 top. Then, when Goldman made its top over here, the lesson learned, MMTs, is what is forward-looking. Look at the top that Goldman put in and pull back to its 2010 bottom, and then take a look at the S&P 500 down here. This is the 2010 part. We had a double month, we only had a double month reversal right here. Look at the lag effect, though. When we put our bottom in there, when Goldman finally put the bottom in there, that we were putting bottoms over here, but there is a lag effect. Okay? And the lag effect is that when you take a look at the S&P, that was on 6/1 of 2010 when the S&P was putting its bottom in. Now, let's take a look here on Goldman. Its bottom was being put in, too, on 6/1 of 2010. But we had the reversal in Goldman throughout the 2009 highs from its bull rally. It had pulled back for several months just like this prior, when it made its low, that we got that 2010 pop up to this 2011 high. Now, MMTs, when you take a look at it thoroughly behind here, you'll see the similar ascending bottoms being put in. And that Goldman had broke out to the highs. The broader S&P had broke out to the highs right up here as well. And then here's the change agent. Here's where things changed. the S&P still had a 1, 2, 3, 4-month advance in price action, and Goldman at the same time in 2011 was putting in its all-time high. And let's take a look at the Goldman correction here to current. When SMF called the market highs, we called the market high right up here at the very high, 1370. Go look at the SMF index videos. The truth and the proof is there. Correction around the corner. The thing about it is, why would we know that we were going to reverse? Now, Goldman, we're still burning the highs of the S&P 500 because there's 500 computated companies that were still, coming out with great earnings. And right here is where we started having trouble in the S&P, right when we called it. This over here is something that we're going to want to look at down here, and that's 5-1. You go to stockmarketpunting.com, look at the indexes and the analysis we did on 5-1 before any of this happened. Let that be your truth. Let it be your guidance as far as directional movement in economic, worldwide, U.S. economic, political, you name it, it goes on and on. Someday you'll be able to buy special documentaries on markets so that you, as a citizen of the U.S., will have a complete library of history with markets and how they operate. However, the thing that the MMTs are going through right now is that Goldman started to move down and it broke below key monthly moving averages, such as the pink line of the 50-month moving average, such as the 20-month is the red line, and the 10-month naturally is the blue line, and most importantly, it's below the 100-month moving average. Now, when you take a look at the broader S&P right next to it, you can see that your same moving averages that are here, you can see that they're over here. And they're rising monthly moving averages. And the 10-month moving average is still on the S&P right now during this correction, and we're currently oversold short term on the S&P. And the thing about it is, MMTs, if Goldman breaks here, it will be forward looking as to this coming down here on the S&P. And I will draw a trend line on the S&P that during the trend cycle managements, that's between daily bull rallies and daily bear rallies combined over a 60-day period, that's 20, 40, 60 actual trading days. And I'm going to draw a trend line down in here. And I'm going to put it right here. Here's where we're going to put that. And it's going to be right about there. That's 1159 on the S&P. And that means this lower trend line right here, take this one out. I'm going to delete it. That's this trend line down here. Okay? If Goldman breaks that and doesn't stop, it will be forward looking as to coming down here. Because what happens is that there is a lag effect, and that the July corporate earnings are not going to be as robust as they were over their 9 quarters of breakout earnings from the very bottom of this bull run. And these earnings have piled it up higher, and things have worked pretty well. And there are a lot of financial turmoils in the world right now with Greece, Portugal, Spain, Ireland. Those are the key for right now. And one thing about our U.S. banking system is correlated to international banking systems. And that Goldman is very internationally connected to the international banking system. That means in many various different asset allocation models, investment models, trading models, everything that they specialize in. SMF specializes as well. We are going to show you that if Goldman breaks this trend line here, then this 10-month moving average here will be violated. Right now, it's going to act as support level. We will see that the market in the S&P 500 in this last 6-week correction that SMF was very, very adamant about and called the top. Go to for your steady references. Please go to the homepage of stockmarketfunding.com. Type in the S&P 500. There should be a sequential order of when we were calling market tops in the S&P 500. And you can use that as your benchmark, as your educational learning. The important thing for the new MMTs to know, this is a major, major, major support line. And if things go bad, Goldman will break this pivot line. And once it does, there will be a lot of selling in the broader market once again, if this happens. It won't happen immediately. We are short-term oversold. And what SMF is saying with its MMT traders is that when we have those daily upside volatility rallies is to be selling short into them. Because at every short-term oversold bounce and bottom is that the upper end of the tier resistance levels are to be sold into, and that's where the money and the profits will print. There is a lot of economic distress going on as we speak this very moment. My time is 8:20 a.m. Pacific Standard Time. 6/18 is the date, and the year is 2011. And it's a Saturday morning. It's a Father's Day weekend. Once again, happy Father's Day to everyone out there from SMF. We hope you have very many profitable ones to come. Short-term bounces will happen, and selling into rallies is what will happen. So that during cycle trends and comparison is if Goldman breaks this here, then you know that there's a lag effect. And I've proven it to you. And once again, when you go back over here to Goldman's last correction where it did find its bottom, the S&P also found its bottom right here. If Goldman doesn't find its bottom here, then it will break first. Then the broader S&P 500 will continue to sell into any up rallies and eventually within the trend cycle make lower lows. And lower lows is where when we look at monthly analysis, that this is not final. It's only the 18th. At the end of the calendar month, it will become a final monthly reading. We were extremely overbought here, but MMTs, take a look at the pattern here. Here's the S&P over here now. Take a look at how you burned here on Goldman, and take a look at how the S&P overshot it here. But then it's failed, but then Goldman's been correcting long before any of this move ever occurred here. It already started it. Remember, we were still breaking higher when Goldman started its correction, then the broader market. The lag effect, the lagging trend, mathematical part of it, has a lag effect, mathematically now. And there is taking the leadership is always important to know where they're at. This is a leader, and it's very broad-based worldwide. Goldman is. Now, granted that if Goldman finds support here, then you're finding support there. If we break through here, you're going to come down, and you're going to find some support on the S&P right around here. About 1210. Or on the S&P, you could have a bounce right here at 1210. There's another area of interest, and I'll bring that up. 1230. Okay, so 1230 is that first pivot. Second pivot's right above 1200. That's where all of these bullish monthly moving averages that the public will make decisions on. You'll see a slew of transactions taking place down here. This is where this S&P has got tier 1, tier 2, tier 3 below a sell through here, down around 1155 on the S&P. Now, Goldman would have to break here first, then, because this reversal that we're in so far can catch up to the broader markets within trend cycle channels, and they're very sophisticated, and I'll do them separately with my MMTs. However, the MMTs needed this analysis today so that new MMTs in the school understand how SMF is the backbone of analysis when it comes to top end reversals on key indexes using capitalism and where we are before the economic picture, forward looking, when we were doing our analysis back in, I would say it was 11 of 2010, that month, November 2010, as to what 2011 would be. And the thing about it is that analysis is very correct. The thing about it is teaching MMTs how to use a leadership stock relative to the indexes such as part of S&P and the Dow and the S&P 100 as well. That is the most important thing. And I will tell you now, MMT, I will tell you now, and here's what I will tell you, MMT. This right here is what we call a monthly moving average convergence divergence. I do teach you what the public makes decisions on, but you know that your decisions are made far in advance before theirs. Because if they were not, then you would not be able to be a market technician pro. Meaning that you can tell how the standard public indicators and how people make decisions consistently. I said consistently. And the SMF platform also validates that. And what I will tell you is that this is a monthly moving average convergence divergence right here. It's minus 1.1728. Here is the last time Goldman made it. This is the 2008 financial crisis. It doesn't matter. What matters is you can see what happens if it goes into a monthly sell signal. We are on the brink of Goldman doing that. If Goldman goes into the monthly sell signal, as it did over here, slightly in 2010, it wasn't very deep, but they're very important to know, and you have to use the weekly charts to be able to wade through that 5-day periods that equal a month now, which is actual 20 days. Okay? One of the things that I'm going to show here is the S&P divergences are still quite positive, Ken Flagg, at 57.8968 here on the monthly. But let me caution everybody here on the monthly S&P 500, you're still overbought at 86.48% DS, Ken Flagg. And it's very important for people to understand that when, you know, the difference between the bull side of it and the bear side of it, okay? And we're short-term oversold, but we're still overbought on a monthly, which tells us that when the S&P comes off the bottom and goes up and hits those resistance levels that we'll be doing another live analysis and live trades with you before the fact, putting those trades on before it happens now, that's the key. And knowing when I am going to get that short-term bounce, but how to sell short into that top-end rally and make that print. And why cycle trends start with 5, 10, 15, and 20 equals a monthly. Compounded by 3 is a quarterly. Divide the quarterly in half, and you got 45. days, that is. So basically on this pullback, what makes short-term bounces and reversal trends in indexes work is short-term oversold on weekly and daily, sure. But the bigger picture is that we're still overbought. Even with this correction here from the high to here. That's right. So it's important to know that the strength of this S&P 500 is very strong on its pullback still, because it's testing its major monthly moving averages where people were coming in and they were buying it. It did not sell through it. Once it sells through it, there'll be stop market orders triggered. Okay? Now, that sell through happens when you break down in here and Goldman goes into a monthly sell signal that you can rally up to the 1320 level here, 50 handles, and then roll over, make a new lower low, and come back down in here, providing that snaps its back there. SMF MMTs, I will be doing the NASDAQ comp, and I will be doing the Dow Jones. And I want it to be monumental for you that you understand the key player here, Goldman and the S&P, or any index, because of its diversification worldwide. And it was selling ahead of time as emerging markets were getting so overheated and inflation started to run rampant, and we put in all-time highs in gasoline prices. But currently right now, in this last week, I think, or in the last month, it's down like 30 cents a gallon. And I said if energy doesn't come down and commodities don't come down, commodities are the next shoe to fall. Because there's got to be some kind of stimuluses back to the societies here. And supply and demand worldwide will be different top subjects that we get involved as far as worldwide productivity. And where the good companies are going to make money, and where the big money will be buying them for the yield that they get, whether it's 3% or 5% or anything better than what the other yields are paying right now. So you've been given today a little bit of understanding of taking a look at a leadership stock, how it's made its reversals way ahead of time, and that it landed at support, and we've landed at support here on the 10-month moving average on the S&P 500. And that we can clearly see by the S&P 500 and the long-term rallies and pullbacks is that Goldman Sachs has done one thing right. It led the rallies up, but it also led the broader markets down as well. Meaning it was a barometer ahead of time that if they're going to be making less money, there's probably less growth out there. They're very well diversified in growth. So basically, as we understand where these key monthly moving averages on the S&P, remember that rallies up to be sold short. If you snap this here, it's going to be what this does, why this comes down, forward looking there. Right now, the bull sentiment and the bear sentiment has changed, as it has. You've got more bulls now that were exuberant have turned pessimistic, and you've got the bear count, which is higher, that you've got more bears into the market, and that's what oversold conditions will do, is that with the oversold market and the amount of bear right now, and we've had a lot of short interest come in the market in the last 2 weeks of the actual 7-week reversal top that we called for. Therefore, markets can get short-term support, because when the shorts get and the bears get all riled up, they're going to buy to cover, and that's how those bounces are going to go up. But then after that procedure is over, look for lower lows. And why would you look for lower lows? Just as you're being taught here on Goldman, that Goldman breaks this line and it's forward looking as to where we are. And if I pull all the other indexes up, and I'm going to do the Dow next, and I'll keep the Goldman here, and then in a separate video I'm going to do Goldman and Google together. And just to give you a little treat of that right now, is this is what Google has done, and this is what Goldman has done, and then you have the broader market doing what it's doing. And that internet that we corrected over here, and we'll get into that when we get into the NASDAQ comp, and we'll use this one for the NASDAQ comp. Powerhouse internet stock it is other internet stocks got at their highs and reversed, and Google led the way. Then the broader market, as I always said, Google, that's when the Amazons and that's when your overbought stocks started to pull back, when Google has lost its big correction here, just like Goldman. And we'll leave this at that. Now, once again, MMTs. It's all about understanding, once again, here's the end of the S&P 500. And here is Goldman. So that's the barometer here. Thank you for cooperating and learning today, because it's very important that all of you start the second half of the year out the right way. And we will be doing that full second half year analysis. We've already done it before the year started, but then we're going to update what that yearly analysis is and how true, correct, and accurate it has proven. MMT students.